Hi everybody and welcome to my channel. So we are going to start a series on consolidated financial statements. So if you are somebody who has been watching my videos on YouTube, you realize that I have already posted videos on consolidation, and those videos covered complex consolidated financial statements where I touched on vertical group structures as well as D-shaped or mixed group structures. However, those videos were actually on-demand videos. They were on demand. That was why I posted them. So this is actually the first video that you must watch on consolidated financial statements if you really want to get started and get going when it comes to group financial statements. Alright, so if this is your first time on my channel, kindly subscribe to the channel and consider liking my videos if you find them useful. Alright, so we are going to get started with consolidation, and this is going to be a very long journey. We are going to touch everything from basic groups to more complex or advanced levels. So at the end of this series, you should be able to get comfortable working around consolidated financial statements in an exam, as well as any other place that you may need it. All right, so we get started. So there comes a time in the life of any business or a business where it might decide to expand or diversify its operations, and this diversification can come in two ways, or it comes in several ways, one of which is acquiring the individual assets and liabilities of another firm, say a sole proprietorship or a partnership. So the business might decide to expand or diversify its operations by acquiring the individual assets and or assuming the liabilities of another firm, a sole proprietorship, a partnership, or a company, a listed company or something like that. So that is one way of a business expanding. Another way, which is very common, is acquiring shares in another company. So a business can also decide to acquire shares in another company, and this is what we call the investment in a company, and it is the most common way businesses expand or decide to diversify their operations. Now, when this business acquires shares in another company, something happens. What happens is that the business in which the shares were acquired continues to exist as a separate legal entity, whilst it becomes a single economic entity with the company that acquired the shares in that company. So assuming company A acquires shares in company B, what happens is that company B continues to exist as a separate legal entity distinct from its owners. Now, if the shares bought by company A gives control of company A over company B, then company B, even though it exists as a separate legal entity, it becomes a single economic entity with company A. So this is how it works. So this is the basic idea of consolidated financial statements. This is how come we have consolidated financial statements, and the focus of the financial reporting exams or strategic business reporting is actually centered around the acquisition of shares in another company. So when a business decides to acquire shares in order to expand in the company, then this is what we call, or this is what gives birth to consolidation. Alright, so that is what we have as a brief introduction to whatever we want to do. So let's continue. Then we have some key terms that the standard IFRS 10 defines, and want to look at a few of them, the most important ones. The first one is control. The first definition that I want to look at is control. So I have already mentioned control. I said when company A buys a controlling number of shares in company B. Okay, now what is control? Control exists, or an investor controls an investee when the investor is exposed or has rights to variable returns from its involvement with the investee, and has the ability to affect those returns through its power over the investee. Now, what this means is that an investor, say company A, invests in another company, say company B, which is the investee. So company A becomes the investor, company B becomes the investee. Now, company A is exposed or has the right to any variable returns. The variable returns can come in the form of dividend, interest on debts, instruments, or any other way in which, in this case, it is shares. So the most appropriate return on that investment is dividend. So the investor, company A, has the right to variable returns from its involvement with the investee or its investment with the investee, and has the ability to affect those returns through its power over the investee. So that is what we call control. Now, this control is usually gained when the investor invests or buys more than 50% of the voting rights in the investee. So that is what happens. This is what gives what we call control over the investee. So whenever the investor acquires more than 50% of the voting rights, the voting rights, what you mean by voting rights is the shares that gives voting rights. So we are talking about ordinary shares. So preference shares doesn't give control over an investee. It is only ordinary shares, because that is where the voting rights lie. All right, then we move on to the second definition, which is significant influence. Significant influence. Now, this definition is actually not by IFRS 10, but it is relevant for our analysis. Significant influence has been defined by IFRS IAS 28. That is investment in associates and joint ventures. So that is the standard that defined significant influence. Now, it is very key to understanding control. That is why I brought it in here. All right, so what is significant influence? Is the ability or the power to participate in the financial and operating policy decisions of an investee, but is not control or joint control over those policies. So when you have the power to participate in the financial and operating policy decisions of an investee, but you are not in control, or you are not controlling, or you don't have joint control over those policies of the investee, then what you have is what we call significant influence. So this is usually established by an ownership percentage of between 20 and 50%. So when you acquire shares between 20 and 50% in a company, then you have what we call significant influence according to IAS 28. You don't have control, but rather significant influence. So as I said, it is fully covered by IAS 28, investments in associates and joint ventures. Alright, now let's look at the criteria for determining control. What do we have to see for us to know that you actually have control? So what that means is that having just above 50% is, even though it is a very good indicator, but there are other indicators that we see to know whether control actually exists. So the first one is the power to direct relevant activities. The power to direct relevant activities. Now, what is power? Power has been defined by IFRS 10, and this is how it defines it. It defines it as the existing right that gives the current ability to direct the relevant activities of the investee. So when you have the existing right, that gives you the ability to direct the relevant activities of the investee, then you have power over the investee. Now, examples of ways that we display this power is through your voting rights, the right to appoint, reassign, or remove key management personnel, your right to appoint or remove other entity that directs relevant activities, or you have decision-making rights stipulated in a management contract. So if you have all of these, then you have what? Power. Now, examples of relevant activities. What are some of the examples of relevant activities that we have? We have what? Selling and purchasing goods and services, selecting, acquiring, disposing of assets, researching and developing new products or processes, etc. Then the second criteria is the exposure or rights to variable returns. And as I mentioned, an example of a variable return is dividend. And another one is interest from debts or changes in value of investments. That is kind of capital gains. Then the third and the last one is the ability to use power to affect the amount of returns that you receive from your investee. Okay, so that is it for the criteria for determining control. So when you have all of these, in addition to the more than 50% ownership shares percentage, then you actually have control over the investee, and you can apply IFRS 10 in preparing your financial statements. All right, then we have an additional content. This is actually a bonus content just for us to understand more what we mean by consolidated financial statements. So we are going to look at characteristics of group accounts. Then what are some of the characteristics of consolidated or group financial statements? The first one is that the financial performance and position of the group is presented as that of a single economic entity. Now, this is very important. So even though the company in which the shares were bought, or the company which issued the shares, continues to exist as a separate legal entity, in the eyes of the ultimate parent, it becomes a single economic entity with a parent. So it is very key. When we get practical, you get to understand it more, but you have to understand that the company becomes a single economic entity. That is why we present a single financial statement called consolidated financial statement, and not separate or combined or uncombined or whatever statements that we might have as defined by the conceptual framework. Then the second one is that the statements are issued in addition and not instead of the financial statements of the parent. So this is also another key concept or a key characteristic of consolidated financial statements. What we mean here is that the financial statements that are issued as consolidated financial statements are not actually on their own. They are addition to the financial statements of the parent. So when you see, for instance, let's say we have the financial statements of Microsoft or Google, you will have the financial statements of Google alone before you also have a consolidated financial statement for Google and its subsidiaries. That is how it is. So the consolidated financial statement is an addition to the financial statements of the parent or the investor. All right. Then the third one is that the cost of investment in the subsidiary is eliminated. The assets and the liabilities of the subs are rather included. So we remove the cost of investment. Now we record the cost of investment in the subsidiary because it is a requirement by IAS 27, separate financial statements. So when you make an investment in the subsidiary, what happens is that the subsidiary here is the company that is being controlled. The parent is the company that controls the subsidiary. All right. Now, the cost of investment is recorded in the financial statements of the parent in accordance with IAS 27, separate financial statements. So if at the end of the day you are doing consolidation, this cost of investment which you applied using IAS 27 would have to change for us to apply IFRS 10. So that is what we have, and we rather add the assets and liabilities of the sub and the parent together. So we will not have that line item called cost of investment in the subsidiary any longer, but we will have a consolidated financial statement where we add the revenues and expenses, or income and expenses, as well as the assets and liabilities and equity items. Asset and liabilities, equity is not part of the subsidiary and the parent together. Then the third one is that group financial statements provide information about the parent company and all the company it controls. So the group financial statements comprise the financial statements of the parents and all the companies or subsidiaries it controls. So that is the group financial statements. Another key one is that only the share capital of the parent is shown in any equity. So as I said earlier that the equity is not included, it's not consolidated, but it is only the share capital or the share capital and reserves of the parent only that is included in equity. So it is only, when it comes to that place, it is only those of the parents that are included. Alright, so in essence, 4 IFRS standards within the financial reporting framework or syllabus are relevant to the preparation of consolidated financial statements. These are: 1. The IAS 27 separate financial statements, IFRS 3 business combinations, IFRS 10 consolidated financial statements, and IAS 28 investments in associates and joint ventures. Now, there is a fifth one, which is IFRS 11 joint arrangements. Now, those ones are not actually consolidated. If the actual standards that are for consolidation are IFRS 3 and IFRS 10. IAS 27 is separate financial statements, and we are going to see an example of a separate financial statement, and then you appreciate the fact that this is where we move from before we apply IFRS 3 and IFRS 10 to be able to prepare our consolidated financial statements. Now, IAS 28 is investment in associates, and you are going to treat that as a separate topic. So don't worry, and we'll get there, and then you understand everything. Alright, so actually, I said that the IAS 27 separate financial statement is not related directly with consolidation, but in order to understand consolidated financial statements, you should know how the investment in the subsidiary is actually recorded in the books of the parent before we later consolidate. Alright, so before you consider the structure of the consolidated financial statements, we must first look at how the investment in the subsidiary is presented in the parent's individual financial statements, and that is where IAS 27 comes in handy. Alright, so the standard actually gives us 3 methods of measuring the cost of investment in the individual financial statements of the parent, and these 3 methods of measuring the investments include: the first one at cost, at the cost of the investment, and the cost of the investment actually can be in various forms. We are going to be looking at those in a jiffy. And also the second one is the fair value, and then the third one is using the equity accounting method. So the standard gives us these 3 options to choose from, any of these 3 methods. Okay, now there is something I have to say before we continue. There are times that the parent might decide not to consolidate. Now, why should a parent not decide to consolidate? The first one is that first, maybe due to poor performance of the subsidiary. So when your subsidiary performs poorly financially, when you consolidate, the financial statement of the parent will also be affected. So the parent might be tempted not to consolidate or not to prepare or present the consolidated financial statements. Another one is that the subsidiary has a poor financial position, and also maybe due to differing activities of the subsidiary from the rest of the group. So when that happens, the parents might be tempted not to present a consolidated financial statement. However, you must know that IFRS 10 does not permit any of these reasons. It doesn't permit them. So there are actually reasons why a parent will not be allowed to consolidate, and those are very different from the points I just mentioned. All right, so we'll be getting to that place. So these are some of the cost measures or the measures by which the parent can present the cost of investment in its separate financial statements. We are going to come across all of these. Equity accounting. Equity accounting is just a method of accounting where the investment in the subsidiary is initially measured at cost and adjusted thereafter for post-acquisition change in the investor's share of the net assets of the associate. Now, this is actually for associates. It is a method of accounting that we use when we are recording an investment in an associate or a joint venture. So we'll come across that when you are dealing with IAS 28. So calm your nerves and then we'll get there. Alright, now let's look at an example of a separate financial statement. This is an example of a separate financial statement. Now, this is actually taken from one of my videos on consolidation, and this is actually on complex groups. What you are looking at is the basic groups. However, I'm doing the introduction to cover everything, but the focus for now is on basic groups. A basic group is simply a parent with one or more subsidiaries. A parent with one or more subsidiaries. So that is a basic group. Now, with a complex group, the subsidiary also has subsidiaries. So that is where it becomes a complex group. It is not actually complex, but because of the complex, the different kinds of investment that we have, that is why we call it complex group. Now, this is a typical example of, or a simple example, of a separate financial statement. So what we have here is that this is the parent P having the subsidiary S. So this is the investment in the subsidiary. You have shares in subsidiary. This is the investment in that subsidiary, and this is the cost of the investment, $120,000. So this $120,000 is what we are seeing that it can be measured at cost, at fair value, or at equity accounting using the equity accounting method. The most common ones are actually at cost and at fair value. So this amount right here, this $120,000 is either recorded at cost or at fair value. Information about it will be given in the additional information, and so you will know whether it is measured at cost or at fair value. Alright, so that is what we are talking about. So this 120 is the cost of investment. So this is how we present it. This is a typical example of a separate financial statement. So this is the financial statement, or the statement of financial position of the parent, and the statement of financial position of the subsidiary. And this is the statement of financial position of the subsidiary. And from here, we know that it is the subsidiary that has invested or that has control over this subsidiary that we have here. So this is what will happen. Then at the end of the day, the parent, the ultimate parent here, is going to consolidate the three figures. That is, we are going to add everything together. However, we don't just add. So when it comes to the equity, we pick only that. When it comes to the equity portion, we pick only those of the parents. So the retained earnings, the equity capital here, we will pick only 200 here. We will leave the rest. When it comes to retained earnings, we will pick the parent only, and then we will pick only the post acquisition. When we get to the practical aspects, you will get to understand it more. Alright, so this is just a typical example of a separate financial statement. Then exemptions from preparing consolidated financial statements. So as I said, I give a bonus information as to why some parent companies do not want to consolidate the financial statements of subsidiaries. Now let's look at exemptions from preparing. What exemptions are there from preparing consolidated financial statement? Now these are the reasons why a parent cannot consolidate. These are the valid reasons given by IFRS 10 why a parent cannot consolidate. The first one is that the parent itself is a wholly owned subsidiary or a partially owned subsidiary as a subsidiary. So forget about the other English. So what we mean here is that so far as you have a parent, so far as you have another parent, then it is only the ultimate parent who has that right, that option, or who should present consolidated financial statements. It is only the ultimate parent. So long as you have a parent, then you are not qualified to prepare consolidated financial statements. So you are exempted from preparing consolidated financial statements. That's what we are talking about here. So when I go back to my separate financial statements here, you will see that it is only these parents who can consolidate these three financial statements. It is only the parents, because even though these parents controls, even though the subsidiary controls another subsidiary, the subsidiary here S cannot prepare consolidated financial statements because it also has a parent. So it is only the ultimate parent that can consolidate both. Alright, so that is it. And then the second one is that the parent's debt or equity instruments are not traded in a public market. So that is what we have here. So that's the second exemption. If the parent's debt or instruments are not traded in a public market or in a security exchange, then that parent is exempted from preparing consolidated financial statements. The third one is that the parent did not file its financial statements with the Securities Commission or any other regulatory organization for the purpose of issuing any class of instrument in a public market. This is closely related to the second point. And then when the ultimate parent produces consolidated financial statements that comply with IFRS standards and are available for public use, then any other parents cannot or is exempted from preparing consolidated financial statements. It is only the ultimate parent who has the ability to do this. So these are the valid reasons why a parent will not consolidate. Apart from these reasons, a parent must consolidate. A parent or the ultimate parent must always prepare consolidated financial statements. Okay, now when exemption from the preparation of financial statements is permitted, when the exemption is permitted, IAS 27 separate financial statements requires that the following disclosures are made. The first one is that the fact that consolidated financial statements have not been prepared. So when you are exempted, what happens? One, you must disclose according to IAS 27 that the consolidated financial statements have not been presented. Two, that a list of significant, or you must disclose that a list of significant investments that is subsidiaries, associates that you have made an investment in, including percentage shareholding, principal place of business, and country of incorporation, are all disclosed in the notes to the accounts. And then you also have the basis on which those investments listed above have been accounted for in the separate financial statements disclosed in the notes. So these are some of the disclosure requirements under IAS 27, separate financial statements, when you are exempted from preparing consolidated financial statements. Let's talk a little about IFRS 3 business combinations. So business combinations, actually, this standard sets out the principles of recognizing and measuring business combinations. Now, the standard actually sets out the criteria for recognizing a business, for recognizing a business combination, for recognizing and measuring goodwill, as well as non-controlling interests. So that is what it does, and it also defines a business. It defines a business in a very concise way, and this is how it defined business. It says that a business is actually an integrated set of activities and assets that is capable of being conducted and managed for the purpose of providing goods and services to customers, generating investment income such as dividends or interest, or generating other income from ordinary activities. So that is how it defined business, and it actually identifies three criteria for recognizing a business. First, a business must have inputs. The inputs are talking about the economic resources or assets that are used to create outputs when processed. So those are the inputs. The second one is the processes. The processes are those systems or standards or rules that, when applied to the inputs, will produce outputs. And then the third one is obviously the outputs, the result of the inputs and the processes that have been applied to those inputs. So this is how IFRS 3 defines business and gives the criteria for recognizing a business. Now, what actually constitutes a business combination? So a business combination is constituted when an acquirer acquires a controlling interest in an acquiree. So when I say a controlling interest, by now you should understand that you have the ability to or you have the right to variable returns and all that. You have the right to or exposure to variable returns, and you have the power to affect those returns. So that is how a business combination is achieved. So a business combination is achieved when the business or the acquirer acquires a controlling interest in an acquiree. That is what we call a business combination. If that happens, then business combination is done. Now, the standard also says that when a business combination occurs, goodwill must be recognized. Goodwill must be recognized. Now, what is goodwill? It also defines goodwill. IFRS 3 business combinations is the standard that defines goodwill, and it defines goodwill as the difference between the aggregate of the value of the consideration transferred, usually at fair value, the amount of any non-controlling interests, and the fair value of the identifiable net assets acquired and the liabilities assumed. So that is how it defined goodwill. So basically what you are saying is that the amount for which you bought the business, the amount for which the acquirer acquired the business, and the value of the identifiable net assets and liabilities of that business that has been acquired, the difference between these two figures is what we call the positive difference. The positive difference between these two figures is what we call the goodwill. Now, when the goodwill is negative, when it is negative, it is called a gain on bargain purchase. Gain on bargain purchase. We will look into that in more detail as we progress. For now, this is just an introductory video, so just calm down. You understand everything as I make more videos on these concepts. So it's also set out the choice for measuring non-controlling interest. Non-controlling interest is actually that portion of the business that is left for that is not controlled by the parent or the acquirer or the investor. So assuming you have 100 shares in a company, and in company B, and company A acquires 80% of the 100 shares, the remaining 20% is what we are calling the non-controlling interest. The non-controlling interest. So it is that portion of the business that is not controlled by the parents. And IFRS 3, business combinations, sets out the choice for measuring the non-controlling interest. And what it says is that we can measure non-controlling interest at fair value, or as a proportion of the identifiable net assets of the acquiree at the date of acquisition. This one too is very practical. When we get there, you will understand. So that is the choice that IFRS 3 business combination gives for measuring the non-controlling interest. Alright, so this is how we end our video on the introduction to consolidated financial statements. We have covered a lot of concepts, a lot of very useful information that will help you get started with consolidation. So if you haven't subscribed to my channel, kindly subscribe to the channel, because I'll be releasing more videos on consolidated financial statements as well as other IFRS standards. So be on the lookout for my new videos, and consider liking my video. Comment in the comment section if you want me to do a video on any particular standard, and I will be sure to look into it. Alright, so thank you very much for your time, and I will see you in the next video.